Welcome to this week's market drama. We'll begin with the S&P 500, which was up 1.2% for the week. It is now up 1.5% for the year. NASDAQ was up even more, up 2.3% for the week, 2% year to date. And that's the story, right? It really was driving the markets, continue to be technology sector. For this particular week, the key catalyst was that there was better than expected demand for semiconductors, right? So Taiwan Semiconductors basically gave us a robust demand forecast. So a lot of the chips manufacturers were up, but also the broader technology sector, Microsoft, Alphabet, Amazon, Netflix, all at fresh 52-week highs. So where does that leave us? Well, we actually hit a new all-time high for the S&P 500 on Friday. The prior all-time high was January 3rd, 2022, right? So that's the good news, is that that's going to create a headline that might even attract new investors to say, oh boy, didn't realize we're all-time highs. The not so great news is that it's still very much a narrow market that's driving this rally. It's all technology stocks that are driving it. If you look at an equal weighted S&P 500, it's actually still down for the year. The other, call it headwind here, is that if you look at this past week, treasury yields went up. Why? Because the expectations, or what the market's forecasting when it comes to probability of the Federal Reserve cutting interest rates in March. Just a week ago, market participants were saying, hey, there's a 77% chance the Fed's going to cut interest rates. As we know, the Fed cuts interest rates. That's favorable for markets, because it's in a way kind of pouring a little bit more fuel to potential economic growth and earnings for companies. That 77% just a week later now looks like a 50-50 shot, right? The market's pricing in the Fed's going to cut interest rates in March, right? So that story was kind of washed out with the markets hitting all-time high with the enthusiasm of technology stocks. But that story, I think, could become important, especially next week when we have PCE and inflation data coming out. As you guys have heard me say a number of times, this is the measure that the Fed tends to favor as a way to measure how inflation is doing on the consumer side. The expectation for core PCE is to fall from 3.2% year over year to 3.0. So we'll keep a very close eye on that. We also have on January 25th, which is this coming Thursday, we have 4-quarter GDP growth estimates. This will be key as well to give us a sense if the economy is holding up, right? Because that's the other part of the equation here. If the economy is holding up, markets might overlook the fact that the Fed might take a little bit longer before lowering interest rates. But if the economy starts to show signs of a recession coming, that might spook the markets. So those are the dynamics here to keep an eye on. Tech enthusiasm driving the markets higher. And on the other side, inflation still being something that hasn't come quite back to 2 or 3%, but is on is way there. Lastly, is the economy holding up, or are we going to see a recession? Because that would be something that the market's currently not pricing, right? The market's pricing an economy that's been fairly resilient, and that it will continue to be resilient in the coming quarters. That's it for this week. Stay tuned for next week.